Advanced Financial Accounting. In this presentation, we're going to work a problem within Excel related to a consolidation process, a consolidation of two company files where we have a parent-subsidiary relationship. It's going to be the consolidation for year one, so the first year after the consolidation took place. In other words, consolidation took place, we're going to say at the beginning of the year. Now it's the end of the year where we're going to do the consolidation. We're going to say that P is going to be the parent company. The parent company purchased 100% of the shares of S, which is going to be the subsidiary company at the beginning of this year, and they did so at the net asset price. Get ready to account with Advanced Financial Accounting. Note that as we go through these consolidation problems, we're going to be stepping up and leveling up in the degree of complexity one step at a time. So we're going to be taking a look at different kind of degrees of complexity as we go. This is going to be one of the more simple type of degrees of complexity, in which case we have one company that's going to be purchasing the other company. We had the 100% purchase. So that means one company is fully owned by another company. That's going to make the process a little bit easier. Also, when the purchase took place, it was at the beginning of the year. So we had the consolidation taking place for an entire year, which is nice rather than having that first year where you have a partial type of consolidation process, or what happens when the purchase took place like in the middle of the year. So we got an entire year, first year taking place. We're also saying that the purchase price that took place is going to be the same as the net asset price of the subsidiary. And that's going to be some of the simplifications that we have. And then again, we'll take a look at some more complications as we move forward. We want to take a look at this case and then think about more complex, or put in some more variables in later examples. Here we are in our Excel worksheet. We got the information on the left-hand side. We're going to be entering that information into the blue area on the right-hand side, and then we're going to enter that into our consolidation worksheet. So we got our consolidation worksheet, and within the consolidation worksheet, we're going to be combining the books of basically our two companies, P and S, and then we're going to put in those consolidation or eliminating entries to get our consolidated trial balance, the thing that we could then use to create financial statements with. So let's take a look at our information. We have P purchased S common stock for $315,000. So P purchases S for the $315,000. S net assets at the time of purchase, we're saying, are the $315,000. So in other words, there was a purchase that took place of the common stock. So they purchased all the common stock, meaning they basically have control ownership, not just 51%, but 100%, right? So P now owns 100% of the voting common stock, and therefore complete ownership of S. And they did so for the net assets price of S, in essence, the book value of S. So again, that's going to be a more simplified kind of scenario that won't typically be the case, where those things will be the same, but we'll take a look at some deviations at a later point. Let's take a look at this first. P uses the equity method to account for investments. So that means that P now is a separate company. There's a parent subsidiary type of a relationship. On P's books, they're recording S's information as of the equity method, using the equity method, which is typically used when you're over the 20%. But they're also going to be required to do the consolidation. So now we've got P's books, which is using the S equity method to show the investment in S, which is a wholly owned subsidiary. And then we're also going to be combining these together with a consolidated financials. Okay, so then make a consolidated financial statement worksheet, and that's what we'll be working on. Notice that the purchase is at the beginning of the current year. So this purchase, we're saying, took place at the beginning of this year. It's now the end of this year, and now we're going to do the consolidation for it. Okay, so first we want to take our consolidation worksheet. So what I'm going to do is, what we would do then is say, okay, let me get the trial balance from our two companies that are involved here. One from P, one from S. If they had accounting software, we could basically export their information to Excel to put it in our little worksheet here. Now note, it works out very cozily and nicely in this case, because we're choosing just basically general type of accounts. Cash, accounts receivable, the general type of accounts. Notice that in practice, if you have two completely different set of books, that especially if you get down to the expenses down here, you're going to have a whole lot of expenses that one company may have named differently than the other company, and you're going to have to go in and try to consolidate the accounts. In other words, one account might call the expense account auto expense, and the other one might call it vehicle expense or something like that. And you're going to have to line up the accounts and and figure out how you're going to combine those two things together. So the grouping is a problem, of course. So once you do this consolidation process in practice, and you have two separate books that were separate books that weren't created in unison, then you're gonna want to see if you can basically look at those GL accounts and conform them as much as possible to make the consolidation process as easy as it can be. So you would like to have these two sets of books using a similar general ledger list of accounts, so that when you put them into your consolidation worksheet, you're not going to have things that are going to say like, this is one type of expense account that's named slightly different than another type of expense account, and they don't line up. If you have account numbers, you'd like to be able to start to line those up as much as possible. Otherwise, you're going to spend a lot of time in your worksheet, of course, and that'll typically be the case in the first year of consolidation, where you're just trying to line up the proper accounts with the proper accounts, so you can consolidate them into the consolidated financial statement. So just note, in practice, obviously with large companies, that will be a difficult task. Here we've simplified that, of course, and these two line up quite well. And obviously, if you're going to be setting up some type of situation where you have a parent subsidiary and you're able to set that up from scratch in some way, shape, or form, what you really want to do is basically set up a similar chart of accounts, basically copy over the chart of accounts from one to the other, so that you reduce that problem as much as possible. So you can be able to put these two charts of accounts together as easily as possible in just a worksheet like this. The more similar the account names and account numbers, the easier that would be to do. All right, so in any case, we've got P and we've got S. We're going to say, okay, we've exported their trial balances. We're lining them up together in our worksheet now, and they fit nice and cozy together here. So we've got our assets, we've got our liabilities, we've got the equity, and we've got the income and expenses lined up. So now all we're going to do, now that we have these, is consolidate them. So now that we have them lined up in the proper account categories, I'm just going to add them together. So now I'm going to get my total over here in my worksheet. I'm just going to say, all right, well, let's sum this thing up then. And so I'm going to sum these two up, and I'm just going to copy that down. So I just added those two together, and then I'm just going to copy this down with the autofill, and there we have it. So that's going to be our consolidated worksheet here. So note what we have here, and I really suggest using this, credits being negative. Notice if I had P having debit and credit column, S having debit and credit column, the total having debit and credit column, the entries having debit and credit columns, and then the total here being debits and credits, this worksheet would be giant. Also note how easy it is in a worksheet like this to calculate things if you have the credits being negative. In other words, I can say, all right, here's P. The assets minus the contra asset account comes out to 1,381,000. The liabilities are coming out to the 253,000, and then we have the equity, the total equity, including the income statement, the 1,128,000. That of course ties out to the assets minus liabilities, 1,128,000, and then we have the revenue minus the expenses, which are the 373, which are calculated down here. So that's just pretty nice to be able to do that. Also note that in S's books, you'll note that we have S here, and the common stock and the retained earnings add up to the 315, because that's before everything rolled in, before we issued dividends and before we had the income roll into it. That 315, you'll recall, was what it was purchased for. So P purchased S for the 315, which is equivalent to their net book value. So we're imagining here their net book value is basically the fair value and whatnot, and and that's how much the stock was purchased for. So that's going to be our equity amount there. Now we also note that then the P company has on the books the investment on an equity basis. So here's the 353 on the equity basis, investment in S. Now here it is in our total. Obviously we can't have, that doesn't make sense when we combine the books together. So we're going to have to, that's going to be part of our elimination process. We're going to have to remove that. We also have this income from S. We're going to have to basically remove that. Now to do that, you might think about, okay, well, how did that get on there? It might be useful to say, well, what were the effects to get that on the books? Well, they're using an equity method, you'll remember. So to get to that amount, what happened when they made the original investment. What did they do? I'll just put this down here. They increased the investment for the 315. So they increased it for the 315 when they purchased. That's what P did. This is the equity method. So they're recording it on the equity method, even though they need to consolidate too. And then they're going to say that they credited, let's just say cash, right? They paid cash for the stock. And then what happened is P earned, we could see their net income, this 73,000. So when they earned that 73,000, or S earned 73,000, that means that it increased by that 73,000. Let's just type it in there. We'll say 73,000 and credit the 73,000. And we're going to say that that is going to go into the income, right? And that's where that income line is coming from. So there's the income line. And then they gave dividends. When they gave dividends, I'm going to say then cash went up on the dividends. And they gave dividends in the amount of the 35,000. So 35,000 is that. And that's going to be decreasing the investment. So what's the effect on the investment? Investment in S. The effect is saying that it's going to be increasing here, and then decreasing here. And that results in that 353. The 353 we see up here. So that might help to kind of think about the elimination process, because those are the accounts we're going to have to basically reverse out. All right. So then what we're going to say then is there's our total. Here's going to be the adjustments that we're going to be making. We're going to make these adjustments here, and that's going to give us our ending balance. So what are these adjustments we need to make? We're going to say, all right, let's say that the investment I know needs to go away. So I'm going to say, okay, I know this account needs to go away. And that one, it needs to go, the whole 353 needs to go away. So I'm not going to build this in terms of debits on top. I'm building it in the way that makes the most sense to me. So I need to credit that because it needs to go away. And then I know the other side, if I think about these journal entries down here, the other side of that investment is basically on S's books is the equity section. Because remember, the net assets are now owned by P. And this line item represents like one line item of equity. In other words, this 353,000 you'll see on S, because they own 100%. Assets minus liabilities are the 353, which are being represented on P's books by that 353. Or in other words, total equity at this point in time, including the equity section and the income, is 353. So the net assets minus liabilities, or equal to total equity, is what is on the books for P related to the investment in S. So basically, we need to remove then the equity over here on S to have this elimination entry. So I'm going to say, all right, well then this equals that means the common stock needs to go away. It's a credit here, so we're going to debit it. So I'm just going to say negative of that number to flip the sign to make it a debit. And then I'm going to get rid of S's retained earnings. So let's go to the retained earnings. And so once again, I'm going to say negative of that 95,000. And then these are the dividends that were declared. Now notice when they give the dividends out, obviously they would usually just take it out of retained earnings. Another debit retained earnings and credit like cash or payable, and then take it out of the payable. So, but I broke out the dividends so that you can see them in a similar way that you would see them in terms of a sole proprietor, where they break out like the draws. So the dividends obviously represent what part of retained earnings, the accumulation of revenue over time that has been taken out by the company and is going to the owner. So these dividends over here obviously were taken out and went to the owner, which is fully owned by the other company, P. So S's dividends went to P. So we need to remove those dividends because they're paying themselves when we do this consolidation. So the dividends are going to be here. And again, remember in practice, the dividends may be in the retained earnings. So you have to look at the GL account for the retained earnings and just see the activity and see that, pull out the dividends that would be in the activity. So then that's the dividends here are debit. So we need to credit them. So I'm going to credit the dividends. So we'll say, okay, we got to credit the dividends. And then the other thing we need to get rid of is this income from S. So this income from S, that needs to be removed. Notice that income from S, because P owns 100% of S, represents the net income here. So the net income, this 73,000, is being represented here. So I'm going to remove this amount, and that means that we could still see the income, the consolidated income together, and just remove the duplication, the income from S being recorded as part of our equity method that was used in order to get to these numbers by P. So let's go back up top and say, all right, so then I'm going to remove the income from S. So we'll remove the income from S, and that's going to be a debit that we need to do. So we're going to do that with a debit. So I'm going to say, all right, so there is that. And I need to flip the sign there. So flip the sign, and that should be it. So then if I look at this, I'm going to say, all right, so there's the 388,000, and the credits are going to be added up to 388,000. Debits minus the credits add up to 0. So that's it. We tie out there. Now, you might want to mull that over for a while and consider that with relation to these entries. These entries are what was used in order to get to P's ending books on an equity method. And remember, as you think about that this is a wholly owned subsidiary that was purchased for the net book value method. All the common stock purchased for the net book value method, and then mull that over a few times. You might want to work through the problem a few times. So let's post that out then. We're going to say, all right, so what's going to happen? Let's go then to, we're going to post this now. So here's the investment in S. So this is just like adjusting entries kind of now, but we have our total column now. And now we're doing our elimination or consolidation entries to get to our consolidated trial balance, which we could then use to make the financial statements. So I'm going to say the investment account, that should go down to 0. So that needs to be eliminated because we can't have an investment account in S when we're consolidation together, and we are basically both S and P as if they were one company. Then the common stock, that's going to be down here. We're going to remove the common stock. And so again, we can't, right? And that's going to reduce this one. So we're back to just the parents here because we can't have common stock from S, which is going completely 100% to P. And then we're going to be removing the retained earnings. So we're going to say, all right, the retained earnings, we're going to say this is going to be equal to the 95,000. So we removed this retained earnings completely, bringing us back to the beginning retained earnings here. And then we're going to say that the dividends, we're going to remove the dividends. So here's the dividends. We're going to say, all right, same thing with the dividends. This is going to be equal to the 35,000. That removes the dividends. So we removed this, leaving us with just P, and that's here now. And we had to do that because the dividends are being paid all of the dividends are being paid from S to the owners, which is all one owner owns 100%, which is now P. So we can't, that would be a double recording. And then we're going to remove this amount. That can't be there, income from S, because income from S, they're one company. So one company can't be representing income from another company. So we're going to say that that's going to be removed. So that goes down entirely. That's going to be our main consolidation journal entry process. Now we also have this issue, however, with the building and the building and machinery and the accumulated depreciation. So basically what we're going to say here is that at the point of purchase, we're going to revalue, in essence, the building and equipment at that point in time. And so what we want to do is basically revalue at that point in time. So that means that, let's take a look at it. It'll make more sense if we look at it. If we got the accumulated depreciation, it has a credit of 40,000 here, and it's only been 1 year of operations. And then we have the depreciation down here that is 20,000. Well, that means the difference between those two, because the depreciation journal entry must have been a debit to depreciation expense and a credit to accumulated depreciation. That means at the beginning of this year, the depreciation, and that's at the point of the purchase of the 100% shares, must have been 20,000. So what we're going to do is we're going to net out the 20,000. We're going to say that as of the point of the consolidation, the machinery was worth the 193 minus the 20,000 at that point in time, and then we'll depreciate it from there moving forward. So in other words, it's going to look like this, and let's see if this makes more sense after we actually do it. We're going to say the accumulated depreciation is going to go down. It's going to go down, and the other side is going to be going into the building. So it's going to go into the building. So, and it's going to be going down by, I'm going to say this equals, let's say negative brackets. And I'm saying what we're getting this number is the 40,000 minus the 20,000 down here. 40,000 minus 20, which of course is the 20. Oh, what happened? The 40,000, because one's a debit and one's a credit. So I'm going to say plus to make it subtract. So we're subtracting those two. One's a positive, one's a negative. So there's the 20,000. And then there's the debit and the credit. So now if we post this out, what's it going to do? We're going to say, all right, the accumulated depreciation is going to go back up. It's a contra account. It's got a credit balance in it. It's going to go back up by that 20,000. And then the building is going to go down by the 20,000, the building and the machinery. Okay, so what that means is what we did in essence is we said, hey, look, at the point in time of consolidation at the beginning of the year, there was 20,000 in accumulated depreciation, and we want to record that basically as the net value of the building and machinery and the depreciable assets, and then depreciate from that point forward. So we're netting out the portion of S's accumulated depreciation that was there at the point in time that the 100% of the stock was sold, so that where depreciation is taking place at that point in time, basically going forward. And that's going to be the essence of it. So now we're going to say, all right, now we've got our consolidated trial balance we can make our financial statements with, and it's consolidated together. Obviously, we got the assets minus the liabilities is now at the 1,128,000. That equals, of course, the total equity down here, which is the 1,128,000. And we have removed any of those accounts that are now showing that there's some kind of intercompany transaction. And really what you want to really get into that, you really want to say, okay, I know I need to eliminate this one. I know I need to eliminate this one. Those need to go to zero because you can't have income from one company to the other. And I know the other side is somehow in the equity section, right? It's somehow, the equity section is being represented on the other side. And that's how you might want to start to kind of piece this together in your mind. But then we've got our consolidated trial balance, which basically represents these numbers kind of as if these two entities were one entity. Now also note that I'm just going to move, so this will probably look like this on your worksheet. Now I'm going to move these numbers up just so you can see them up top. So you could just see those transactions as part of our worksheet.